I think this mid 20 area is super deep value, right? So when you look at things like dormancy flow or like, just a bunch of different on-chain indicators are kind of deep value. Now, at the end of the day, you can have these wicks that go well below that if there's kind of like liquidity crises. But overall, I think we're kind of in that range where I don't know exactly where the bottom is going to be. Obviously, I think you're in the phase where if you're dollar cost averaging or you're layering in purchases, I think this is a good place to do it. I think trying to catch some sort of like micro bottom is kind of a fool's game. Uh, some things I'm watching, for example, I was watching the tether peg because it's kind of a sign of liquidity, right? If that peg is struggling, in addition to whatever concerns people might have about the quality of the collateral, it's a liquidity sign, right? So liquidity is being sucked out of the space so fast, so it's hard for anything to rally. And when you start to see that kind of recover to the extent that it recovers, that's kind of a sign that maybe the worst is behind us, and some projects will continue to bleed out, but maybe the highest quality things like Bitcoin, they might already have their capitulation in. And so it's hard to say for sure, but I think that anywhere in with a two handle, you're basically getting into kind of deep value range, and then it just comes down to managing your own risk bucket, right? So a lot of people think they can withstand volatility, and then when it actually happens, they realize they can't. And so I think it's important to have the position size that makes sense to you so that you can have, unless you're an active trader, so that you can have a 3 to 5 year, position and let that play out, according to your thesis or not. So years ago, when Bitcoin was a smaller market, the group of people that traded Bitcoin and the group of people that traded every other asset was like two very different groups with minimal overlap. And so over time, as Bitcoin reached greater levels of adoption, both retail investors and institutional investors, that Venn diagram is kind of moving closer together, where the same people own both types of assets. Um, and so naturally, I think correlation increases in that regard, right? And generally, when Bitcoin is a liquidity play and a macro play, it's going to follow that kind of risk on, risk off things. And so with the stock market during rising PMI environments, you generally see the riskier stocks do pretty well, and during the declining PMI environment, that's when things like defensive stocks, or gold or bonds, generally outperform some of the riskier stocks. Now you always have exceptions, right? So in this declining PMI environment, instead of bonds doing well, bonds sold off because this was the first stagflationary declining PMI environment in a while. So there's always going to be curveballs. And so, a big question I had was, how would Bitcoin hold up this time in a stagflation environment? Because if you're going to have a decoupling, you would think that a stagflationary environment would be a decent time for it. So, you know, if you start to see margin pressure on companies, and you see the Fed forced to come back and provide liquidity, I think that could be an environment where Bitcoin decouples favorably from broad equities because companies are basically forced to pay higher wages. They're forced, they have all sorts of struggles with their supply chain shortages, things like that. While Bitcoin doesn't have margin pressure, doesn't have employees to play, things like that. And so I think it can decouple when you have very specific conditions that are hurting stocks that are not necessarily hurting Bitcoin. So basically, if liquidity is positive but margins are not great, that should be at least a decent shot of a positive decoupling. But we're not there at the moment. Right now, we're still seeing liquidity being pulled out, and so you see a lot of correlations go to one. And so another thing that fed the whole correlation issue is macro, because it's been an unusually strong macro environment. So you had the COVID crash, then you had the biggest liquidity bazooka we've ever seen, and so, the correlation of almost everything went up. And then as that liquidity bazooka is withdrawn, you see a lot of things roll over together. And so because we had a bigger than normal macro impulse, we have a bigger than normal amount of correlation. And I think over time that can separate. And things can separate in terms of size as well. And so, for example, you can say, okay, Bitcoin and ARK are correlated, but if you look at a 5 year chart, Bitcoin has killed ARK in terms of total returns. And that's because over time, one is getting structural adoption and the other one less so. And so you can decouple in terms of timing, or you can just decouple in terms of magnitude, where say up days you do a little bit better, down days you do a little bit better, and over time you slowly separate from weaker assets.
how do you kind of think through inflation moving forward towards the end of the year?
So monthly inflation's been high for over a year now, and when that happens, you start to kind of peak out in terms of year over year because you no longer have that. Basically, all the base effects wore off, and so let's say a 0.5% inflation every month, over a 12-month period, like when that starts to play out, you're going to be much higher year over year inflation than prior because your baseline is like 0.1 and 0.2% year over year inflation, and once you've had a full year of 0.5% month over month inflation, if you keep having that monthly inflation, your year over year inflation actually peaks out. It doesn't mean it goes down, it just means it kind of peaks out. And so you would need to see monthly inflation accelerate in order for year over year inflation to keep going up. Um, and so what we're seeing now is that the supply side is still very problematic. Energy companies are not really producing more energy. Uh, China lockdowns are rippling through the whole global supply chain. Semiconductors is still a problem. The eastern seaboard of the United States is nearly out of diesel, which is catastrophic. Um, Fertilizer is still a problem. Basically, there are still structural supply side problems, and I think these are going to persist for a very long time. Um, Now, what we're seeing on the other hand is that demand is weakening because stimulus is being withdrawn, right? So when you're putting a lot of money and giving it to people, you could have that more inflationary impulse, and as you pull that away, then you're more likely to get economic contraction because people are forced to pay more for their food and energy, and they have to pay less. They have to tighten their belts everywhere else, right? So it's harder for other things to raise prices, and you start to get decreased economic activity and shortages. And so one thing that I think could make inflation come in not as high as people think is that it can manifest in shortages, right? So shortages are basically a type of inflation that doesn't show up in the numbers. If I want to buy something and let's say I'm willing, let's say, you know, they're out of paper towels and I want to buy some paper towels and I'm like, I will literally pay 50% above asking price if someone has paper towels to sell and I just can't find them, right? That would have been if I could find them, that would have been a high inflation print, but because I can't get them at all, it just shows up as a shortage. It just shows up as decreased volumes. So I tried to buy a car several months back and they didn't have any of the models I wanted, and I just didn't buy a car. And if they would have said, "Hey, we have the car, it's 20% above asking," I would have been, "Yeah, okay. I'm gonna have it for a decade anyway, so it doesn't matter." Whereas because I couldn't even make that purchase, it doesn't show up as inflation. It just shows up as decreased economic activity. And so I think the combination of shortages and inflation are going to continue to various ways, but we're seeing that shift over time because it's no longer that high demand impulse. It's supply side scarcity and declining demand. And I think that's eventually going to do some sort of forcing function on either the Fed to reverse course, or we could start to see more targeted fiscal stimulus. You see in Europe, for example, some of them are doing energy subsidies, and I think we could see something like that in the United States. We start to see political pressure to address some of these situations, and so that could be that could increase liquidity in markets, but it's basically a very challenging decade going forward, I think, in terms of inflation.